It started. The U.S. debt bomb did not explode the way people imagined. There was no single morning where the dollar vanished. No dramatic press conference where politicians admitted the system was broken. No movie scene where Wall Street traders ran through the streets holding their heads. It started much quieter than that. It started with a number most people scroll past. $39 trillion of total public debt. Then another number. More than $31 trillion held by the public. Then another. A 10-year Treasury yield still sitting around the mid-4% range, and a 30-year bond around 5%. And if you are watching this thinking, Andres, why should I care about some government debt chart when I am just trying to pay rent, buy groceries, save a little money, and not get destroyed by the next bill? That is exactly why this matters. Because when a country carries too much debt at low interest rates, it is a problem on paper. But when a country carries too much debt at high interest rates, it becomes a machine that quietly reaches into everyone's pocket. Not all at once. Not with a siren. Through higher borrowing costs, weaker purchasing power, tighter credit, more taxes, smaller benefits, more inflation pressure, more market volatility, and a government that has less room to rescue people the next time something breaks. And what most Americans do not understand is that the debt bomb has already started imploding inward. It is not blowing up the system from the outside. It is compressing the system from the inside. The government owes more, so it borrows more. Because it borrows more, investors demand more interest. Because interest costs rise, deficits get bigger. Because deficits get bigger, the government has to borrow even more. That is the spiral. That is the part nobody wants to say clearly. The scary number is not just the $39 trillion. The scary number is the interest clock attached to it. Imagine you have a credit card balance so large that even if you stop buying new things, the monthly interest keeps pushing the balance higher. Now imagine you did not stop buying new things. That is the federal budget. And I know some people will say, but Andres, the United States can print money. The United States controls the reserve currency. The United States is not like a household. And that is true. A country with its own currency is not exactly like a family sitting at the kitchen table. But that argument is only comforting until the bond market starts asking for compensation. Because printing money does not delete consequences. It moves consequences. It moves them into prices. It moves them into yields. It moves them into the value of the dollar. It moves them into the grocery aisle, the mortgage payment, the rent renewal, the insurance premium, the tax bracket, the retirement account. The debt does not need to default to hurt you. It only needs to be serviced. That is the trap. People are waiting for a collapse. But the actual collapse is the slow transfer of national income from future opportunity into past promises. Every dollar paid in interest is a dollar that cannot be used for roads, defense, healthcare, tax relief, education, innovation, or emergency support. Interest is not a program. Interest does not build a bridge. Interest does not cure cancer. Interest does not protect your retirement. Interest is the bill for money already spent. And right now, that bill is becoming one of the biggest items in the entire federal budget. This is why I keep saying on this channel that the biggest financial risks are often boring before they become obvious. They do not arrive as breaking news. They arrive as math. And math does not care if voters are tired. Math does not care if politicians need applause. Math does not care if cable news wants a villain. Math just compounds. Let me show you the part that should make every saver sit up straight. When interest rates were near zero, the government could roll old debt into new debt cheaply. It was like refinancing a mortgage from a bad rate into a miracle rate. That era trained Washington to believe debt was almost painless. Borrow $1 trillion here, borrow $1 trillion there, and the interest bill looked manageable because money was cheap. But cheap money changed behavior. It made deficits look less dangerous. It made investors chase risk. It made real estate prices explode. It made companies borrow aggressively. It made households believe low rates were normal. Then inflation came. Then rates rose. Then the old debt started maturing. And this is the part people miss. The government does not pay today's high rate on every dollar immediately. It rolls into higher rates over time, like an adjustable rate mortgage resetting piece by piece. That means the pain does not hit in one dramatic second. It leaks into the budget year after year. A treasury bond matures. The government has to issue a new one. The old coupon was low. The new coupon is higher. Multiply that by trillions. That is the implosion. That is the debt bomb folding inward. The debt stock is enormous, and the refinancing rate is no longer free. So even if politicians magically froze spending today, which they will not, the interest math would still keep pressure on the system. Now bring this down to your life. Why does this matter if you have a job, a savings account, and maybe an index fund? Because government debt competes for capital. When the Treasury needs to borrow massive amounts, it has to attract buyers. Pension funds, banks, foreign governments, insurance companies, money market funds, regular investors. To attract buyers, the Treasury pays interest. If that interest is high, it becomes the benchmark for everything else. Mortgage rates price off the bond market. Corporate borrowing prices off the bond market. Credit card rates, car loans, business loans, private equity deals, real estate valuations, dividend stocks, growth stocks, all of it feels the gravity of Treasury yields. The government bond is supposed to be the safe asset. So if the safe asset pays a lot, risky assets have to justify themselves. That is why high debt and high rates can compress stock valuations even without a recession. It changes the math of what future cash flow is worth. It changes the math of buying a house. It changes the math of starting a business. It changes the math of retirement withdrawals. And it definitely changes the math of holding too much cash at a bank that pays you nothing while the bank earns more on safe government debt. This is why banks love confused savers. They love people who keep $10,000, $20,000, $50,000 sitting in checking accounts earning almost nothing while short-term Treasury bills and money market funds pay real yield. I am not saying everyone should move every dollar tomorrow. You need emergency cash. You need liquidity. You need FDIC protection where appropriate. But you also need to understand the spread. When rates are high, because the government is desperate to borrow, your idle cash becomes valuable to someone. If you do not demand a return on it, someone else will capture that return. That is the personal finance side of the debt crisis. The government borrows at higher rates, banks and funds position around it, and regular people who are not paying attention get quietly diluted. Diluted by inflation. Diluted by taxes. Diluted by low bank yields. Diluted by higher interest on their own debts. This is not about panic. Panic is useless. This is about positioning. Because when the debt bomb implodes, the winners are not the loudest people on the internet screaming about collapse. The winners are the people who understand the channels of damage. Channel 1 is inflation pressure. Channel 2 is interest rate pressure. Channel 3 is tax pressure. Channel 4 is benefit pressure. Channel 5 is asset price pressure. Start with inflation. Governments with large debts have a political incentive to prefer inflation over default. They may never say that out loud. They do not have to. Inflation makes old fixed debt easier to repay in cheaper dollars. But it also quietly punishes savers, wage earners, retirees, and anyone holding cash too long. That does not mean hyperinflation tomorrow. It means the long-term incentive is clear. If the debt is too large, the system often chooses currency erosion over visible default. Then, interest rate pressure. If investors become nervous, they demand higher yields. Higher yields mean higher interest costs. Higher costs mean bigger deficits. Bigger deficits mean more borrowing. That is the doom loop people talk about, but they usually make it sound like a one-day crash. It can be slower and still destructive. Then tax pressure. At some point, if interest consumes more of the budget, politicians look for revenue. They may not call it a tax hike. They may call it closing loopholes, means testing, bracket adjustments, new surcharges, higher payroll caps, changes to capital gains, estate taxes, retirement account rules, or inflation that pushes you into higher nominal brackets. The label changes. The direction is the same. The government needs more money. Then benefit pressure. Social Security, Medicare, defense, and interest are the giants. If interest keeps growing, something else gets squeezed. Maybe benefits get adjusted. Maybe eligibility changes. Maybe premiums rise. Maybe taxes supporting those systems rise. Maybe the promise stays on paper, but the purchasing power of the promise weakens. And finally, asset price pressure. When safe yields are higher, speculative valuations become more fragile. Real estate cannot ignore mortgage rates forever. Growth stocks cannot ignore discount rates forever. Private equity cannot ignore refinancing forever. Zombies companies cannot ignore debt service forever. The market can rally in the middle of all this, yes. Liquidity, AI enthusiasm, earnings, buybacks, and sentiment can push prices higher. But underneath, the hurdle rate has changed. And that is why the old playbook may not protect people the way they think. The old playbook said, keep cash in the bank, buy the biggest house you can afford, assume rates will go down, hold a random mix of funds, trust the government will figure it out, and worry later. That playbook was built for a different interest rate world. The new playbook has to be more intentional. First, your cash must have a job. Emergency money should be safe and accessible, but lazy cash should not be donating yield to a bank. Compare high-yield savings, money market funds, treasury bills, and short-term treasury ETFs. Understand FDIC insurance versus treasury backing versus fund risk. Do not chase yield blindly, but do not accept zero because your bank hopes you are asleep. Second, your debt must be attacked strategically. In a high-rate world, paying down bad debt can be one of the best guaranteed returns available. A credit card at 20% is not a lifestyle issue. It is a financial fire. A car loan at a painful rate is not normal just because everyone has one. It is a drag on your future cash flow. Third, your portfolio needs to be built for policy risk, not just market risk. That means diversification across asset types, tax buckets, and liquidity windows. Traditional retirement accounts are useful, but they are also future taxable income. Roth accounts are useful because they create tax flexibility. Taxable brokerage accounts are useful because they give liquidity and capital gains treatment. Cash-like instruments are useful because they protect you from selling stocks during bad moments. Real assets can help, but only if the debt structure does not destroy you. The point is not to predict the perfect future. The point is to stop being fragile in multiple futures. Fourth, your income matters more than ever. When the government has a debt problem, the middle class often becomes the adjustment mechanism. Prices rise, taxes shift, benefits get debated, and employers become cautious. The person with one income stream and no savings is exposed. The person with skills, side income, assets, and liquidity has options. This is why I talk so much about building income-producing assets before you need them. Not because passive income is magic. Most passive income is not passive at the beginning, but because one paycheck in a high-debt, high-rate world is a single point of failure. Fifth, stop confusing political arguments with financial planning. You can blame whichever party you want. You can be right. It still will not protect your money. The debt was built by decades of promises. Wars, recessions, stimulus, tax cuts, spending increases, entitlement growth, crisis responses, and a political system that rewards today's comfort over tomorrow's math. The market does not care which speech you liked. Your mortgage lender does not care who you voted for. Your grocery bill does not care which side made the better argument. Your plan has to work in the world that exists, not the world you wish politicians had created. Now, I want to be very clear. I am not saying America is finished. I am not saying sell everything and hide under the mattress. That is lazy fear content. America still has enormous advantages. The deepest capital markets, world-class companies, innovation, energy resources, military power, legal infrastructure, immigration demand, and the global reserve currency. But strong countries can still create painful decades for unprepared households. Rome did not need to vanish overnight for ordinary people to feel the currency weaken. Britain did not need to disappear for the pound to lose dominance. Japan did not need to collapse for savers to endure decades of strange financial conditions. The United States does not need to end for your personal finances to be damaged by the debt cycle. That is the key distinction. People hear debt bomb and imagine apocalypse. I hear a debt bomb and think, what happens to my cash, my taxes, my mortgage, my portfolio, my income, and my retirement assumptions if the government has to keep borrowing at expensive rates? That is a much more useful question. And here is the uncomfortable answer. The people who get hurt most are usually the people who do nothing because the crisis does not look dramatic enough. They wait for confirmation. They wait for a crash. They wait for an official announcement. They wait until inflation has already eaten the cash. They wait until mortgage rates already changed the housing market. They wait until taxes already shifted. They wait until their bank has earned thousands from their deposits while paying them pennies. They wait until their portfolio drops and then panic sell. They wait until retirement and discover that the government promise is not the same as personal security. Waiting feels safe because it avoids decisions. But in a compounding debt system, waiting is a decision. It is the decision to let the system allocate the cost to you by default. So what should you actually do this week? Not someday. This week. Pull up your bank accounts and ask, what is every dollar doing? Emergency fund, bills, investment, debt payoff, opportunity fund. If a dollar has no job, assign it one. Pull up your debts and rank them by interest rate. Anything high interest deserves urgency. Pull up your investments and ask whether you understand what you own. If you own 5 funds that all hold the same mega-cap stocks, you may not be as diversified as you think. Pull up your retirement accounts and ask whether all your future income is taxable. If yes, learn about Roth options, backdoor strategies if applicable, conversions, and tax planning with a professional. Pull up your income and ask what skill could raise your earning power over the next 12 months. Not a fantasy business. A real skill. Sales, coding, editing, design, accounting, operations, AI tools, healthcare, trades, management, content, consulting. In a debt-heavy economy, income flexibility is protection. And finally, build a personal treasury strategy. I do not mean become a bond trader. I mean understand the safest yield available to you. Understand treasury bills. Understand money market funds. Understand high-yield savings. Understand duration risk. A 30-year bond can move violently when rates move. A short-term bill behaves very differently. Yield is not one thing. Safety is not one thing. Liquidity is not one thing. Learn the differences before fear teaches them to you expensively. The U.S. debt bomb has started, but the real story is not the headline number. The real story is the transfer. From taxpayers to bondholders. From lazy savers to smart cash managers. From people with variable debt to people with fixed assets. From people who wait to people who prepare. From people who trust slogans to people who read the math. And maybe that sounds unfair. It is. But personal finance is not about whether the system is fair. It is about whether your family survives the system better than it would have if you ignored it. I am Andres, and my message today is not panic. It is awareness. The debt bomb does not have to destroy you. But pretending it is someone else's problem is exactly how it gets paid by you. The government has its balance sheet. Banks have theirs. Wall Street has theirs. You need yours. And from this point forward, every dollar in your life needs to be treated like it is living in a country where the interest bill finally came due.